welcome everyone again. Hope you guys have makan already, right? I think to just recap again, for tonight, we're gonna talk about how to analyze or perhaps how to look at financial statements as a overall lah. Yeah. In a broad sense, I think financial statements. I'm pretty sure you guys would know what financial statements are. In a broad sense, it basically just tells us the financial health of the company lah. But then again, where do we start looking at it, or what kind of stuff that we really should be aware about, especially if you're newbies? Where can we get the statements and whatnot? I think for newbies, I think these questions would need to be addressed before we can actually start your journey on that lah. So without further ado, I'd like to invite my co-host. I think you guys will probably know her already. Familiar face among Rakuten Trade users, right? Come and welcome Jun Ting on board. She's from the research team of Rakuten Trade, right? Hello, Jun Ting.
Hello, everyone. This is Jun Ting. Thank you, Hui. So, good evening, everyone. Welcome back to our RakuTalk session 2. So, I agree with Hui that when new investor, newbies, or even some of the investor coming to reading financial statements, they find it complicated, or there are too many financial data and they don't know which is the important one to focus on. And I even saw this one comment just now: reading financial statement is very easy separately, but how do you link that? So today, I'm going to start simple, and then we will go slightly deeper, to dissect what are the important elements of each financial report, as well as how do you link those financial report together and come to interpretations of whether this company is healthy in terms of the financial or not. So let's start. Right. So so I'm sharing my screen now. So today I'm going to share with you all understanding financial reports and also our stock picks. Right. So before I start, just want to introduce some overview of my presentation today. So I'm going to bring you all to understand some of the basic concepts of financial reports. And I noticed that some investors, sometimes they're quite confused between annual report and quarterly reports. What are the functions between both? And then the three financial statements in a financial report, which are income statements, balance sheets, and also cash flow statements. And we will do some recaps. And of course, lastly is our stock picks. Okay, so let's give 1 or 2 minutes back to basic first. So imagine you are from a personal point of view. You have your salary. This is your business income. And you have to minus all your living expenses, your tax expenses, then comes to your net personal income, comes to your saving. Then another side, you have your assets, such as your property, car, or stocks, and you have loans as your liability. So when we study a financial health of a person, we also look at their net worth, which is assets minus liability. But what's most important is the cash flow of this person, because the main intentions of a financial report, the main intentions of a business, the main intention of the financial ecosystem is to generate a very good stream of cash flow. So let's move into more deeper, wider, which we move into from a corporate perspective. Now you have new things like revenues, which is the money that you receive through the sellings of your products or your goods to your customers. And to run your business, you need expenses, staff costs, administrative costs, your depreciations, interest expenses, tax expenses, and then come to a profit, right? Then moving to another segment, which is the assets of a company, like current versus non-current assets, equipment, machinery, properties, customers, inventory, and then liabilities, where you have your bank borrowings and your payables in your liabilities. So here, equity is a new term when it comes to a company, managing a company and also corporate. So I'm going to explain equity in more detail later on. And of course, to run a business, you need cash flow. Like if you want to buy new assets, you can fund your asset by raising more cash through your liabilities, or you sell new product and then you got new income, then you utilize this cash flow to increase your asset, and then even utilize your asset to generate more income for you. So this is how the cash flow. But how to so all these financial data, they are individual alone data, and all these financial data, the company recorded in all financial reports. So it's very important for us, for investor or as an analyst, to dissect the segment and to study the health of the financial of the company. So how do they record it? So what kind of report that recorded? Sorry. So the first, revenue and net profit, they are recorded in income statement, which shows the profitability of a company. Then for asset and liability, it shows the net worth of a company is recorded in second financial reports, which are balance sheets. And cash flow, which is, I think, is most important one, is recorded in cash flow statement. So it's more to accounting, and it's actually not complicated to understand that. And as an investor, you really have to do your homework, because it's just like a language of a business. Okay.
Right. Right, Junting. I think wow. Really kickstart it in a very great manner. So just to for everyone's info, I know the fact that I think for normal, not normal people, like people who doesn't really understand finance in a way, right? I think all we probably look at would be just net profit. Okay, I think basic understanding people that okay, as long as the company's net profit for each quarter or year it increases, it automatically means that the company is doing well, right? So obviously, I think what you're trying to say here is that as a person that would like to know more about financial health of company, obviously we cannot look solely on the net profit itself. What you're trying to say is that to look as a more broader picture, probably we have to look into their assets, liabilities, and possibly cash flow as well, right? Is that what you're going to tell us in this slide?
Yeah, and then from that report, you're able to link all the numbers together and to see whether it's worth for you to invest that company or not. Okay.
Right.
So okay, then because I often get questions from investor, how do I get those reports? So a very quick one, you can just go to Bursa Malaysia, look for company announcements, then you just choose for annual report or financial result, which are quarterly reports, or you can get those reports from company websites. Right, and also very brief explanations, annual report versus quarterly report. So as the name goes, annual report, the company release the report annually, so that it's for investors to make yearly comparisons. And there are different level of disclosures of information between two reports. I would say annual report is more detailed, but quarterly report definitely is up-to-date results. So in the annual reports, you can see those past key financial highlights and their profile of management and also profile of board of director, where they come from, which area are they specialized in, and also the management discussion and analysis that the management share the prospect and outlooks of the company. Same, under the annual report, there are three main financial statements, which is income statement, balance sheet, and also your cash flow statements. While for quarterly reports, it released quarterly. There are 4 quarters in a year. So it's very important for investors, especially for analysts, to make quarter and yearly comparisons. So I would prefer quarterly report because it is up-to-date financial results. And
Okay.
also for analysts or investor to track the seasonality of the company. And you have first quarter, second quarter, third quarter, fourth quarter. You sum it up together, then there's go the release of annual report. So these are the main functions between annual report and also quarterly reports. This is the example of the annual report snapshot, where it shows the 5-year historical performance of a company and also some of the very colorful infographic. And in terms of this quarterly report snapshots, I think especially for those new investors, they are very confused when they open the quarterly report. So the first one brought up would be this income statements. So there are 4 columns. What are the difference and how do we interpret that? So it's very direct, very simple. So the first column, as you see, I take example of Carlsberg Brewery Malaysia Berhad. This is the 4th quarter result of financial year 2020. So the first column gives you the results of the latest quarter, which is the 4th quarter, October until December of financial year 2020, and make comparison between the the 4th quarter of financial year 2019 last year. So with this, you can make a quarter result comparisons comparing to last year. So I hope this will make you more clearer. So you compare 4th quarter financial year 2020 to 4th quarter financial year 19, right? So for the 3rd and 4th column, this is the cumulative numbers of the financial results. Let's say now is 4th quarter. So this column is sum up or the 1st quarter, 2nd quarter, 3rd quarter, until 4th quarter, the 4 quarters financial result, and it's sum here. And same goes to this column. So you make yearly comparisons between financial year 20 and also financial year 19. Okay, just very simple and direct as that. So another thing is that quarterly report also give you a comparisons with preceding quarter. This is in financial notes of the quarterly report. So this is 4th quarter ended 31st December, and you compare with the last quarter of September. So this is illustrations of the comparison, current quarter versus last quarter in the same financial year. Just very direct and simple as that. So I explained all the basic concepts and also the difference between annual report and financial report. Annual report and also quarterly report. So let's start with the first financial statements of financial report, which is income statements. So as we all know that income statement, it tells the profitability of a company, how profitable the company is. But how can we tell whether this company is much more profitable than peers, other industry, or other players? So I'm going to dissect the few important elements and explain why these are important so that you guys can take notes later. So revenue, very direct. Sales is the amount of money profit that you receive from the selling of your products or services through your customers. Then the next level, which is important, is gross profit. So this gross profit is a result of the deductions after cost of sales. It's very important here because it tells you how the company manage their manufacturing costs. I give an example, let's say a bakery. So revenue comes by selling number of cakes. So cost of material would be raw material like eggs, sugar, so flour. So these are the cost of material and then come to the gross profit. So in terms of gross profit, one have to check the consistency of the gross profit and also gross profit margin. If there is a fluctuation between the gross profit margin, so it could be due to there is some volatility in the price of raw material or the manufacturing cost of that company itself. Then we go to the profit or loss before operations, or we call it operating profit or operating loss. So other operating expenses like your admin expenses, your rental expenses, those park under here. And then to run a business, you need to pay your interest because you have borrowings, unless that you are a zero borrowing company. And it comes to a profit before tax. And finally comes to your net profit. So as what we mentioned just now, not only look at revenue, but you also compare revenue and also net profit together. Because net profit is your earnings, is whatever that you receive after deduct all your expenses. So there's another very important margin here, which we call net profit margin, equal to your net profit divided by your revenue. Let's say if your net profit margin is 10%, means that for every 100 ringgit worth of products that you sell, you get back 10 ringgit and put in your pocket. So other than your net profit, there is another level that I would like to highlight, which is gross profit. This is also a great example, especially if you are a sector that very sensitive to the raw material price or commodity-based company. It's very important because to run a business, you think it in a very simple concept. In order to be able to sustain long, it's either you can control the pricing, you can set the price, or you control your cost. That's all. If you want to put it in a simple terms to run a business, either you set your price or you control your cost. So that's the idea of whole income statements. It tells you how profitable the company is. Well, next, secondly, you have noticed that there are some small numbers under shared notes. So this is what we call financial footnotes. And you'll notice that annual reports is very, very long. So some of the investors, they just focus on the first few pages and they don't know what are the pages behind, what's the function of them. So these are all we call financial footnotes, where it gives more additional information that helps to explain how a company arrived at that financial figures. So go back to the last one, let's say revenue notes 21. So you scroll down to annual report or your quarterly report, look for item 21, revenue, then you see some breakdown. And as analysts and investors, it's very useful for us to dig more information other than asking for management or attend AGM or any other briefing. Right? So other than that, even in some financial reports, quarterly reports, some of the company, they disclose much more information, like the breakdown of the revenue from different region or segments. Some even break down customers like customer A, customer B, customer C, and customer D. So this is the functions of the financial footnotes. Don't just focus on the financial statement itself. So just scroll lower a bit, then you're able to read more details about the additional information of the income statement. And then number three that I would like to highlight, very important for income statement, is when we study the profitability of a company, focus on core earnings, which we call recurring income, which is the income that coming from the operations of your company. It's not one-off, and you have to remove those one-off gain or disposal. So I give you an example. This is United Malacca Berhad is a plantation company. So their normal operation is sell plantation-related products to get profit. And then in annual report, financial 2020, they managed to turn to profit from last year. It's looked amazing, but if you just look at the breakdown of the income statement, they actually have a gain on the disposal of some of the assets. So this is something that one-off, which you won't get it from your daily activities. So you have to exclude this data to get the recurring income or core earnings of the company. So as I mentioned, even in management discussion and analysis in annual report, you can read more details like management that mentioned if excluding this one-off gain, it is still making losses, just that the losses was narrowed. So this is from annual report. And if from the financial results, look at the notes. So they also mentioned what are the extra items, like they had this one-off gain disposal due to the sell asset. So it's very important to tick only the core items of the income statement. That's rule number 3 for your income statements, right? Okay, so then I'll move to second, balance sheet. And okay, so I'll explain it very simple way. So I think some of the new investor or some investor, they mm, they must have seen this equation before: assets equal to liability plus equity. So we are not asset, we are not liabilities, but what is equity? To make it in a simple term, equity is just the share capital, the capital that raised from your investor. So let's say you want to set up a business. So you find investor A. Investor A would like to invest 100,000 into a business. So the 100,000 is your equity. Okay, but how does this whole equation works, and how does it link to balance sheet? So I give you a very simple example. Let's say you're running you want to set up a factory. So in your mind, you need to buy machinery, and then inventory. You need to stock up inventories, and also you need a property. You need a plant to run your business. So how do you fund all these assets? There are two ways. It's either through bank borrowings, or you can use your own capitals, or the capital from investor, whichever who willing to invest money into your business, or you are already running a business and now you want to add your production capacity, so you can utilize the previous accumulated earnings, means that the earnings, the profit that you have accumulated previously, to add into your asset. So use bank borrowings and also other capital, own capital, to fund your asset. That's how it's linked to this equation: asset equal to liability plus equity. Assets, they are different kind of assets, but main we categorize into two: current assets and non-current assets. Liabilities, current asset, and so non-current liabilities. So current means is within 1 year. If current asset means that the asset that can be liquidated within 1 year, can be turned into cash within a year, like your deposit. Non-current asset are most like fixed asset that it's very hard to liquidate into cash within a year, like your property, your equipment. Those are very hard to sell within a year. Same goes to liabilities, which your current liabilities is your debt, your financial obligation that has to be settled within a year. And then current liabilities, it can be settled more than a year. Well, equity, as what I mentioned just now, is share capital, the money that you raise from your investor, and also the retained earnings reserve, which is your previously accumulated earnings. Then we go to balance sheet. So this is a very simple balance sheet of a manufacturing company. As well, I mentioned just now, this is the part of asset. You have non-current asset. So property, plant, and equipment, fixed asset, make up very big chunk of this non-current asset. And then you have other items as well. Then this goes to your current assets, your inventory, your trade receivables, and cash and bank balances. So let me share some extra info. For trade receivables, it's actually your customers. So some investor, and it's also very useful for you to compare this trade receivables with a revenue, to compare the growth. If your trade receivable grow significantly faster than your revenue, means that means that the selling of your goods not fast enough then you collect your payment. It could be due to you have overextended your credit term to your customer and they pay it, but at the same time you're selling fast. So this is not a very good sign. And also you have cash and bank balances that made up your total assets. So next we have non-current liabilities and also current liabilities. Non-current liabilities are those long-term, that's your long-term borrowings. Current liabilities, like your short-term borrowings, and they goes the sum of your total liabilities. And remember I mentioned about equity just now. We have share capitals, which is a capital raise, and also your reserve, where usually people call it retained earning as well. After paying all the dividend, then they grows your total equity. And remember there is a formula that your asset is funded by your liability and your equity. So this number, asset, should be equal to equity and liability. So this is how it linked together, and how you compare your trade receivable with the revenue linked with your income statement. That's another way. So in this balance sheet, there's another very important gearing ratio that you have to take note, which is gearing ratio that measure the debt level of a company, which we call gearing ratio, where you use your short-term borrowings plus your long-term borrowings divided by equity. Of course, the lower the gearing ratio is preferred, means that the company has lesser borrowings. But it depends on the industry, because some of the industry like concession business, their debt level, their gearing ratio is usually higher because the capex requirements very high for them. So sometimes they need to finance via bank borrowings to fund their asset, right? And just something that extra, you can also link your income statement and your balance sheet via one ratio is return on equity. So you use your net profit divided by equity. This ROE, the higher the better, because it tells you how efficient is the company utilize the shareholders capital, shareholders money to generate income. That's ROE. Okay. So that's for the second financial reports, which we call balance sheets. So the third one, I'll say it's the most important one, cash flow statement. Profit is not equal to cash flow. So remember this. Yes, I agree that intention, the purpose to run a business is to generate enough profit, but the real intention behind is to generate enough cash flow, because cash flow is very important. It helps you to manage your liquidity, and also it measures the inflow and outflow of money from your business. If you have enough cash flow, then you can reinvest your cash flow, buy more assets. So those assets helps to generate more revenue for you, and then more net profit, and then the cycle just goes in a business. So cash flow is very important. So in the cash flow statements, there are three main cash flow: cash from operating activities, from investing activities, and also from financing activities. But what's more important is from the operating activities. Okay, so here, maybe a bit technical or more slightly detailed or in depth here. So we start. This is the first page of cash flow statement. Yeah, cash flow from operating activities. So I use the profit before tax and then do some accounting adjustment. Then what's important is here, the working capitals minus all the changes in the working capitals, then come to your operating cash flow. So these working capitals, which involve your receivables, which is your customers, and also your payable, your supplier, make a very major contributing factors to your cash flow. So working capital is equal to your current asset minus your current liabilities. It shows how you manage your short-term liquidity in operating your business. So it's very important to understand the reasons behind this working capital. How does the increase in inventory or increase in receivable affect the cash flow, and why? I give you a very, very simple example. Let's say this company, it's doing expansions into new market, or it's expanding the production capacity. So that's why all this need investment in current asset working capitals. So because you expand to new market, so you may need to stock up more goods, and then thus it makes your inventory higher. So you increase your inventory levels increases, and you use more cash to stock up more stocks because you're expanding to new market, and that's why it reduces your cash flow. Okay, that's one example. Then second example may not be a very efficient example, where the company delay the payment to supplier to boost the cash flow. So if you delay too long, it's not that really efficient. It's not the healthy working capital that we want to see. Or there's another third example where in your receivable, your customer, or which is you overextended your credit terms to your customers. Let's say your normal terms you have to pay within 30 days or 60 days. But now you extended the credit terms to your customer. You say, oh, you are my customer, so I extend for you, you pay within 90 days or 120 days. So if there's overextended credit terms to your customer, or your customer delay payments, so you're unable to get back the cash, it will affect your cash flow as well. So that's why when studying cash flow statement, look at this working capital changes and have to understand what is the reason behind the changes in those working capital. And right, another main point in understanding and studying analyzing cash flow statement is that it's actually very, very rare or very difficult to find a company with their operating cash flow growing every year in tandem with the revenue, profit, operating cash flow. If that's so, then this is a really perfect case. It's very hard to find that. So focus on a consistent positive operating cash flow, right? So yeah, that's why cash flow is really important, and focus on positive operating cash flow. So second segment of a cash flow is your cash flow for investing activities. So the purpose of this is for me to see the capital expenditure via the purchase of property, plants, and equipment. So also extra information here, there are two different kind of capex, capital expenditure. One is a maintenance capex, and also another one is growth capex. Maintenance capex as in this is the capex that you must spend to maintain your operation. For example, you have your machines already spoiled, so you must change your machine in order to continue operations. That's to maintain your business operation. So that's what we call maintenance capex. So growth capex is you're adding more lines so that it can generate more revenue for you. But sometimes, well, in financial statements, you don't see the breakdown. You don't see the company breakdown. Or what's the maintenance capex? What's the growth capex? Because it's really, really hard to draw a line between maintenance and also growth capex. It's just like additional information. And you have cash flow from financing activities, where if you get more loans, then your cash flow from this higher, and if you repay your loans earlier, your cash flow reduce. And add up all three together, you get a cash and cash equivalent, which is should be the same in annual report in under the current asset segments in your balance sheet. So this is how the three segments link together. And even before that, you see increase in inventory, those receivables, payable, those are the items in your balance sheet. So balance sheet tells you how much inventory they have now, how much receivable they have now. But cash flow tells you the changes. How does this company utilize the cash flow? And how the inventory level change, how the receivable change period over period. Okay. So first, cash flow for operating activities is very important. Focus on consistent positive cash flow. And second, I would like to introduce another very important, which is free cash flow. Means that it's a cash flow in excess for you after spending or the capex or the investment. You can use this free cash flow maybe to pay dividend or invest more in your assets. But how to get into free cash flow? It's very easy. You just use your operating cash flow minus your capex, then you get a free cash flow. So next, I'm going to share a real case study, very interesting one. So this is a company A, listed in Bursa. I got it from Bloomberg. So since listing, this company has been performing very, very well. Its revenue growth, like wow, surged from 700 million to 6 billion in a span of 6 years, and margin quite healthy. While the growth is very, very like supercharging growth, exponential growth. That's look very good in income statement. And then when I pick up the free cash flow segments and I calculate the free cash flow, and I noticed that the trend is actually diverted, so net profit growing higher and higher. But your free cash flow is directing your net profit. And remember that net profit is not equal to cash flow, where good net a company with a very, very high net profit doesn't mean the company has a very high operating cash flow. Okay? So that's why it's very important for you to study the cash flow company. And this is the oil and gas company. in Busan, Malaysia, which they had audit issue this year. Yeah, so it's a very interesting case study. Okay, then lastly, in your financial elements in financial reports that I want to highlight again, dividends. So when look at dividends, please search for keyword propose. So there are two categories. One is dividend paid. This is what I got it from quarterly results, Hong Kong Financial Group for quarter financial 20. So this is the dividend that the company already paid. So it was paid. So if you want to look for dividend, so please look for this keyword proposed. So in item 13, the company say that it has a dividend of 25 cents per share has been proposed by the company, right? And then with entitlement date and also payment date to be announced later. So with this, I would like to highlight again. So okay, how do you get those X date, dividend date, X date, entitlement date, and also payment date? Just go to Busan announcement, search for entitlement. So this will show you what is the subject, final dividend, how much, where's the X date, and also the payment date. So remember, buy before X date so that you be entitled for the dividend. Okay. So let's recap that what I have shared just now. So first, annual report versus quarterly report. Each type of report has their functionality, while quarterly report is an up-to-date report where it helps you to track quarterly performance and also whether there's a seasonality in the financials of the company. And then second, moving to income statement, it shows the profitability of a company by studying their profit margin. And don't forget your gross profit margin as well. You have to make sure whether it is consistent. If not consistent, why? The reason why behind. And number three, focus on recurring items. Okay. Then balance sheet shows how the debt level of a company, and return on equity it's a combination between income statement and balance sheet that it shows that how good the company utilize the money that raised from investor to generate profit. So usually if you have 15% to 20% kind of ROE considered quite good. And number four, very important, cash flow statement. Profit doesn't equal to cash flow. So you have to focus on your working capital, see the changes behind, the reason behind the changes of working capital, free cash flow, and also look for positive operating cash flow. Okay? And then another thing that I want to highlight is that accounting items actually may vary across different industry, especially income statements where the income statement of a bank is different from because it's slightly different from manufacturing company. So this is the thing that you should take note. The example that I share is the more general one, manufacturing company. So after I explained what are the key elements in a financial statement, so actually investing is very simple. You don't think it very complicated. Just focus on fields and link all the numbers together. Why? Think from a business owner perspective. Does it make sense for you to do this kind of investment? Why they want to venture into this business? It's simple, but it's not easy because business is very interesting. It evolves over time. Management change, industry change, and the world is changing in terms of technology, in terms of development, in terms of human behavior. So there's no 100% a market leader forever, and there's also no 100% market losers forever within a certain industry. That's why I would say investing is simple but not easy. It's actually a quote from Warren Buffett. So since it's not easy, so my final advice to all the investors, which I always advise them, at least do your homework. Make sure you know what company you're buying, at least which industry is this company, what kind of products, and always stay updated with company announcements. Check Busa, and even there are some lots of new apps that give you notification when there is a new announcement from company, and also up to date with the company's development. So that's all for my sharing of understanding financial ratio. Okay, so
Wow, that's a lot of insights there, Junting. I think I just on the highlight. I think especially on the cash flow. I think it's pretty evident now the importance of looking at cash flow, and perhaps net profit may no longer be a sole indicator that everyone should be looking at right now, especially in the pandemic. Right? I think I read it somewhere before. Some articles were actually saying that in this current pandemic situation, I think cash flow would somewhat be a more relevant indicator to look at, because it basically indicates how well uh, how financially stable you are in times of crisis, right? So if you kind of mismanage your cash flow a little bit, even though your profits are wow, right, are like super great, but then you didn't really manage how your cash reserve. So it just maybe points out that the management may not be efficient in handling the cash management. Yeah.
yeah, sometimes it may not because due to the management is not efficient. It could be due to the economic impact like
Right.
COVID-19, and also the oil price plunge last year, and it makes really a lot of small oil and gas firm bankrupt because high debt level. Yeah.
Right, right. All right.
Okay.
I hope you guys, the audience there, would get a lot of insights from you, Junting.